to today's macro to micro pre-market briefing. If you're trading the markets today, you absolutely need the right setup. So, we're going to give you a rapid-fire explainer of overnight geopolitics, plus the critical technical levels you need on your screens right now. Let's jump in. We're kicking things off with a massive number and, honestly, a lot of urgency. 20 million. That's how many barrels of crude are flowing through the Strait of Hormuz again over the past 24 hours. Shipping is actually normalizing. So almost instantly, our focus is shifting from the battlefield straight to the bargaining table, especially as the IAA presses for inspections and diplomats scramble to secure those shipping lanes. All right, let's look at phase one, the macro and geopolitical map. So overnight, we saw this fragile Middle East ceasefire barely hanging on. But hey, it is holding, and US-Iran technical talks are actually resuming. But if you look at Wall Street, it's a bit of a weird picture. WTI oil slipped below $70, and the US 10-year Treasury yield dropped a solid 9 basis points. Yet, the Nasdaq still dragged. Why? Well, it's a mix of profit-taking and some real jitters around semiconductor and AI infrastructure. Basically, oil is back to pre-war levels, which finally woke up bond yields, but the tech sector kind of tripped on its own feet anyway. But don't let that drop in yields completely fool you. Check out this number right here. 86.1%. That is the probability markets are currently pricing in for a December Fed rate hike. The US dollar actually extended its gains because everyone is expecting this tighter policy. It's a huge factor, and it's exactly what we need to keep in mind as we map out today's currency charts. Which brings us to phase two, global currencies. Let's start with the dollar index, the DXY. Technically, the structure here remains a super clear buy on dips. We actually hit our target of 101.80 yesterday, which is great. Now, we've got a really heavy macro data docket dropping today. We're talking US Q1 GDP, PCE, and durable goods. So we're eyeing resistance up at 102.10 and support down at 101.41. Yes, the 10-year yield fell alongside oil, but if we get robust PMI numbers and hot data today, that could push the dollar right back up. Now, take a look at this quote from ECB President Christine Lagarde. She says, "If inflation is expected to deviate significantly and persistently from the target, our response will need to be sufficiently forceful, but at present, we do not see any such sign." She's clearly not rushing into a forceful response right now. And honestly, that hesitation sets up our euro chart perfectly. What's really fascinating here is the catalyst. We've got an early July NATO meeting coming up with Donald Trump attending, and that's acting as a sort of soft catalyst to gauge evolving US-EU dynamics. Looking at the technicals, the EUR-USD pair remains a solid sell-on rise. But quick heads up, tread carefully here because it's definitely oversold at the moment. Keep an eye on that resistance at 1.1388 and your support down at 1.1310. Moving over to the British pound, GBP USD. Cable has literally dropped to one-year lows, finally finding some support at 131.50. So what's driving the drop? It's a combination of an acute political vacuum and some really sticky service sector inflation. Keir Starmer's sudden June 22nd resignation triggered a massive labor leadership scramble. And bond markets, they're terrified that frontrunner Andy Burnham might loosen fiscal rules, which has made gilt yields incredibly volatile. Tactically, we're looking at a sell-on rise, but again, be cautious, it's oversold. If it breaks below 131.50, that opens the door all the way down to 130.44. Now for USD JPY. The waiting game for intervention continues, while markets basically test the Bank of Japan's resolve. The BOJ's June 24th summary just revealed a consensus for a terminal rate near 2%, and that caused Japanese government bonds to reprice super aggressively. Plus, falling oil gives Japanese policymakers a little bit of breathing room, which is probably why they haven't rushed in to prop up the falling yen just yet. Our tactical view? Sell right here, but keep a tight stop at 162.00. Support is clustered in that 160.55 to 160.85 range. All right, let's pivot and get into phase three, the India focus. Yesterday was an absolutely massive day of domestic cheer. Banking stocks completely stole the spotlight. Why? Because the RBI stepped in and allowed loans against foreign currency deposits. This gives lenders some crucial financial elbow room and really improves their funding flexibility. Add in fading rate hike fears, and traders quietly packed away their bearish forecasts. We saw bond yields and OIS rates drop sharply, and the Nifty, it gained 0.83% to close at 24,021. Benchmarks are actually up about 4% over just the last 9 sessions. Looking at the rupee, USD-INR actually bucked the broader Asian weakness, edging higher to close at 94.6650. This was heavily supported by likely RBI intervention, basically state-run banks selling dollars, which offset the pressure from that stronger US dollar we were talking about earlier. The price action was essentially a spike that got immediately sold into, setting up a very clear sell-on-rise tactical view. You're looking at resistance at 94.92 and support at 94.51. And all of this beautifully illustrates our nifty technical setup. Yesterday was just a textbook buy-on-dips environment that worked flawlessly, totally fueled by the slide in crude prices and those RBI relief measures for the banks. 11 out of 16 sectors advanced, so we are absolutely maintaining that buy-on-dip strategy. Our next clear target is 24,344. You've got strong support at 23,900 and down at 23,741, which, by the way, sits right at the confluence of the 21 and 50-week moving averages. So what does this all mean? As we head into today's session, with oil falling back to pre-war levels, what's going to take the wheel? Will the heavy macro data dropping today dictate the next major breakout, or will the incredibly fragile geopolitics in the Middle East steal the show again? Keep your eyes on those charts, trust your levels, and get ready for what's sure to be a volatile open. See you out there.